Well, welcome, middle class investors. Thanks for coming in today. This is Seth Martin, your host. And like normal, or like usual, we have the S&P 500 ETF up. So let me put the index up. This is the index that I just put up. And you can see that we're still selling off quite a bit. Last week was kind of a reprieve, but then this week it picked up again and selling accelerated. Now we're in a small little DP off of this wave 4 low, but my guess is this won't hold much. We might get a little bounce here, but we'll probably slice through this and probably come all the way down here to this 2400 area, 2300, something like that. But one of the things I want to recap with you that we talked about that I think is really important, and I don't know if I recapped last week about it, but hold on a second. Let me get this. It's hard for me to get. It's hard for me to get both of these in the shot here, but let me. Yeah, I don't know. It's going to be difficult. Let me try that. But we talked about how, we had a peak in the MACD here, and that corresponded with this peak in 2016. And then we had a peak here in the MACD that corresponded with the most recent high. And what we were talking about is that even though the market made a higher high right here, the MACD right here made a lower low. So there's a lot of different ways to measure this. Is called a market divergence or bearish divergence or intermarket divergence. There's a lot of intermarket divergences. You could look at advanced decline lines. You can look at all kinds of. You can see the peaks here together in case you couldn't see them in that last view. There's a peak there and that peak there, and this is a higher high than this was, and yet the MACD made a lower low. And we talked about that a couple of weeks ago. And we said, this is usually not a good sign and there should be some selling. And of course there was. Now there's not, sometimes bearish divergences don't work out. But this one's on a weekly chart, and I think it was definitely worth mentioning and worth looking at. So in hindsight, it's always 2020. But, when the market is stretched, we had a lot of sentiment indicators that were at 8-year highs and crazy numbers like that. So when you see a divergence and you also have some of this other weight of the evidence that we talk about, it's probably something you shouldn't ignore. Now, a logical question might be, where do we go from here? I mean, where's this market going? And the answer is always, there's no way to know for sure. But I think a good guess, a good rational guess based on what we know about the way markets behave, is we come just below this pivot low here from 2000. Whoops, that's not where I wanted to be. It jumped to the. Delete that. It jumped to the thing, and I didn't want it to jump there. I want to come just below, like right here. And I would say, a good guess is around this 2500 area, which is another 150 points or so from here. So, strap in, hang on, get ready. Now, it could just blow right through this, but if it's going to stop, which it may not, a good logical place would be right in this area. Now, one of the reasons it may not is we need to go to a shorter time frame. Let's go to a 9-month, see if that's going to be good enough. Yeah, so let's zoom in on this and do a little analysis. So here's the tricky part. Some people think, well, once you understand Elliott Wave, man, that's all you need. You're ready to go. But here's some of the problems you have with Elliott Wave, and I think this is a good opportunity. This is a good place to cover that, given what we see here in the market. So this clearly looks like a 1 down, especially in hindsight, right? And then we had a 2 back up. And then we had this kind of move here. We had this move here with a little move up, and then we had this big move. So the question is all of this 3, or was this 3, and this was a 4, and then we had some sort of extended 5? Okay, in which case now this is 2 of the next larger degree, and this is 1 of the next larger degree. This right here would be 1. So this is what you don't know. So am I expecting, some sort of ABC from here back up, maybe back up to the underside of this line here to retest this off this pivot high? Or am I expecting, this is 3, this is 4, this is 5, and we're going to roll all the way back, like I said, to this. In other words, I guess what I'm trying to say is, there could be a 2 all the way up to here, or 1 could have already happened of the next degree of trend, and your 2 may only go up to about here. So you really have to, if you're in this market and you're looking to get out, you have to be real careful about making your decision here. Let's say you try to get greedy and get all the way back up to here, but the market doesn't play. It doesn't play with you, and only gives you an out somewhere in here, in this area. So again, this is where it's a challenge. Okay, it's difficult to make that decision. The problem is if you did get out here at the early one, then you probably couldn't get back in a 401k quickly enough to get back in to capture this. So you just got to pick your pot. You got to pick your spot. But clearly, we've had some sort of 5-wave move down. Whether this is 1, 2, 3, 4, 5, and then this is 2, and then this is the beginning of the next series of ones. 1, 2, 3, 4, 5, or this was 1, 2. All this was 3, and this is 4, and this is 5, and we're gonna get a 2 up into this area. I don't know. There's no way to know. There's no way to tell you which one is the right one. But certainly, we want to see what the market does in this area. We want to see how it behaves. Now, if it comes and it makes kind of an ABC up to here, then maybe the odds favor this. But if let's say Monday it opens and it really blows all the way up here pretty quick, and then pulls back, and there was no zigzag on the way up here, then maybe the pullback's going to flush some people out, and then it's going to make its way up to here. Because if it just goes straight up to this point, the market doesn't just go straight up. It's got a zigzag. So if it does go straight up into this point, then I would look for a pullback and then another leg higher. But if it goes up a little bit, pulls back, and then goes up the rest of the way, then this is likely your exit point. Okay? Hopefully everybody understood that. This whole decision-making process is a challenge. But the good thing about having some sort of plan or some sort of I'm gonna take the MACD off just so we can look at the price action easier. The good thing about having some sort of plan is you're not subject to the psychology of this going. I mean, let's just look at this for a second. Market pulled down, ran up, pulled down. Nobody was worried here, okay? And then all of a sudden this week happened. People started getting worried. But then the next week we gapped up, ran all the way back up here, and all of a sudden magically nobody's worried again. And then and ran down a little bit, finished the week, in the lower half of the range. But then this past week, ran down again. So now people are worried again. So this is the roller coaster that I was talking about. This is the psychology. It's so hard to pull the trigger. It's so hard to pull the trigger here and get out when you turn on the TV and everybody's going, "Oh yeah, that was it. It's over. It's nothing but up now," and you don't really know. So you're thinking, well, maybe they're right. Maybe I should just get back in, and then boom, you get this. So the psychology of managing this kind of activity is really challenging. And like I've told you before, the professionals, it's two different people, right? There's an analyst, there's somebody that analyzes various stocks in the market, and then you have traders that trade it. But when you're doing it yourself, you got to be both these people, and it's just a challenge. It's just hard, and so that's why I always say, just pick your spot. And if it goes through that spot, you're out. You're just done. Okay? Because here's what I believe. If I can miss the bear market, and I mean the really big bear market, let me go back. Let's pull up an all data. Let's take it off log so it's a little easier to see. This is 1932 here. We ran up, pulled back into the lows of 1942. And then ran up this whole time, all the way through the 60s and 70s, all the way up to 2000. This is believed to be the, what do they call it? This is where our standard of living peaked, right here in 2000, okay? I don't know what we call that. They call it something. And then we spent the next, 10 years zigzagging down into the base of the financial crisis. And then we spent the last 9 years, going up with, in the Obama administration and partially the Bush administration. So what I see, and maybe I'm just fooling myself, but I see a wave 1, I see a 2, I see a 3, all the way up to 2000. I see a 4 that was made up of an ABC down, and then I see 5 up. Let's take some of this off so it's easier to see. Hide. Where's my quick toggles? Hide drawn items. There we go. Of course, now that I've hid the drawn items, it hides everything, right? So, but you can see here. Hopefully, you can see here. There's a 1, a 2, 3, all the way up to here. 4, 5. Okay. And then inside here, inside this 3, there was a 1, 2, 3, 4. 5, okay? And then even here, there was a 1, 2, 3, 4, 5 up to here. So there's several breakdowns of the Elliott wave in here. But so what do we know? What do we know about? What do we know that after you get 5 waves? Now this 5 waves again started in 1932. So the pullback is going to be substantial. The pullback is not going to be this 10 to 15% correction people are talking about. It's going to be much, much larger than that. So your investment strategy really should be, how do I avoid this big bear market? Because 10 or 15%, I agree, is not going to hurt you. But 80 to 90%, or even 70%, if we only go down 70%, it's going to hurt you. It's going to take you a decade or more to recover that money. So what we really want to be able to do, you can see here, we're right at the beginning. You just want to pick a place in here where you're going to say, you know what, that's enough. I've had enough down. I'm not taking any more. And maybe that's right here around 2,500. Maybe that's a little higher. But what do we know about the Elliott wave model? Well, what we know is that the first place the first stopping point is the previous wave 4 low. So we're coming down into this area here, and that's just to maintain the trend. So even if you lost this, even if you went all the way back to 2009, that's still a lot. I mean, you don't want to suffer that kind of loss. So where's the other 4th wave? The other 4th wave is right in here. So we're probably going back to this 4th wave low right here. Okay, and you can see we just started. So we've got all this. Okay, and then what? So what is that? Well, we could have it could be an A, B, C kind of a thing. So A, B, C, okay? And then we rally, A, B, C, maybe back up to there, okay? Maybe back up to 1800. And then we're going to have some sort of 1, 2, 3, 4, 5. So, 1, 2, 3, maybe let's do 3 to there, 4, 5. Okay, so we're talking about, this is very possible. Okay, this is what's called a 3, 3, 5. Okay, very possible. But you're looking at potentially, the 1987 lows. This is 1987 right here. 1987 low is right here, right there. That's the 1987 low. So that doesn't look like 1987, but it is. So, obviously, and let's just think about it for a second. Let's say it runs down to here, and then it rallies, right? And you're like, oh God, thank God it's, I lost so much money there. Thank God, it's rallying. And then you're going to kind of forget about it. And then it's going to roll over, and it's going to start going down. You're going, well, maybe it's just a pullback before another leg up. And then it breaks through your previous low where you were already sweating it. And now it's on its way to a new low, a substantially new low, back down to the 2009 lows. And you're going to hear, right here, you're going to hear all kinds of, that's it, that's the end of it, it's the bottom, it's the bottom, it's the bottom. But I want to remind you, this 5 waves was from 1932. So this has to be substantially larger than just a few years. This has to be like 15 years or something. Now, there's nothing wrong with entering here and taking some money in this move up or this move up, okay? But just understand where you are. Just understand where you are in the big picture, okay? Because if you go to sleep and forget about it again, then this is going to happen, and it's going to take out another low. And you're just demoralized at that point. You're just chasing. You're chasing. About the time the market quits going down, you get out, and then it starts going up, and it goes up and up and up. And by the time it quits going up, you get in. You're just chasing it. So you gotta have. This is one of the things I like about this model is it gives you some perspective as to what could happen based on what degree of trend you're in. So this whole financial crisis happened here in a wave C in a cycle degree trend. Now we're in a super cycle. Now we're at the end of a super cycle move. So this was the end. This right here, 2000, was the end of a cycle move. Okay, and then after 2000, we had an ABC, right? So we had an A, B, C. It was called a flat. Okay, and it was. Think about how devastating that was. Okay, and now that we've gone another 5 waves, now we're at the end of super cycle. So super cycle degree, which started in 1932, which means this is going to have to be significant of this move. So this move here, this cycle degree 5 went from, in other words, the 1 was right here. So 1, 2, 3, 4, 5. Okay, but look where it went to. It went all the way back to this, basically this low right in here. Okay, so let's just say we do the same, but now we're a degree larger. Well, we're going to at least go back into probably this area here, which is below 500. So, look, I'm not trying to convince you. I'm just trying to get you to understand that the model helps us understand where we are in the trend, so that you know about how long the bear market will last, so you can develop a plan that'll help you make money even during the bear market, like, at least in these areas right here, between here and here. And then you'll know, okay, it's about, somewhere in here I got to step aside. So you have a plan. Having a plan is super important. And then executing your plan, that's another, again, these are the two functions, right? Have a plan and then execute the plan. In the professional world, those are two different people. For you, it's one person. So you got to have a plan, and then you got to go execute on the plan. And those aren't always easy. So let's get back to a weekly. Let's look at some of the other stuff that we normally look at. Let's look at the 10-year yield. As mentioned, the 10-year yield is looking like it's pulling back. Look, if the market continues to sell off, which it looks like it will, the 10-year is coming back into this area here. Okay, it's coming back into here. At least. And it could come all the way back into here. Around 2%. It just depends. So, if you're in bonds, go ahead and hang on to them a little longer. You've held on this long. And, at least sell in this area. And if we get a rally and it looks like it's going to roll over, then you could be selling in this area down here. Okay. In fact, that's from here to here is not enough of a sell-off given the amount of time. Again, time and price are important. So when you look at this, let's say this is 1, 2, 3, 4, 5. Okay. Well, if this is a 4, which it looks like, I mean, we should be coming back in here to around 2% before we make a leg higher. But that's going to require, it's probably going to mean the market's going to sell off pretty hard. So, if the market sells off hard, just watch the market, and when it starts to look like it's bottoming, then this should be ready to turn too. So, in other words, when the market's going down, yields should be going down, or bond prices should be going up. So just kind of remember that relationship. Real common when the market starts selling off, they're very closely coupled. All right, volatility. You can see volatility expanded over the last several weeks, and even this past week continues to expand. So we're still not over here at these highs back from when the wave 3 top happened, but we're well on our way. I mean, we could be there next week maybe. The rest of the world is selling off. I mean, it's let me put my studies back on. Take that off. So you can see we broke out. I think I talked about last week or maybe the week before that, pullbacks or corrections happen inside a channel. But if this breaks out of the channel, then that's telling you now the direction of the trend is this way. So you can say that Germany is likely topped and is not going to be making new highs anytime soon. We haven't been able to say that until this week. Japan, kind of leaned on it here, but then came back. So you can't really say that Japan has topped yet, okay? It's possible that it reverses and goes up and makes a new high from here. The UK, I think you can say that the UK is topped and is probably going down from here. Now, it might come down a little lower and then retest this and then fall again. But it's at least coming back to these lows around 20, 25 and a quarter. I think that's pretty obvious. What else do we have in this segment? Yeah, let's switch over to the regular charts, the TOS charts. Let's look and see what we have over here. So, that's the SPY or S&P 500. Let's look at the euro. So the euro, came down, made this low right here at the beginning of 2017. And I'll be honest with you, the euro's been tricky lately. A little bit tricky because it looks like it came down to this fourth wave low, but I can't tell if this is an ABC or if this is just A of ABC, which it could be. And, I don't know. My feeling is that the euro is going to go higher from here, maybe up into this area, and then roll over and make a lower low than these lows. But It's hard to say. It's hard to say. Again, you gotta pick your spots. Great Britain. Great Britain looks. It could be that it's coming off of an ABC, and this is the first move up, and we're looking for an ABC move down, and then Great Britain could be going up in here to the 1.75 area, or it could just rally a little bit here and then break down, and this could be the end of an ABC down. We just have to play out. It's not sometimes on these week-long scales, it's hard to really take a position that favors one direction or the other. All right, this is oil. I kind of drew out maybe a potential path for oil. It had such a large move up that it made me think this is probably a triangle, and so we should consolidate down into some lower prices before breaking down through the triangle to all-time lows, which will be below this $26, $26.14. Let's look at gold. Kind of had this idealized path for gold, and it looks like maybe we're finally heading that way. It really chopped around here a lot down here, spent a lot of time down here, so put in a pretty good bottom, I would say. But it looks like now it's wanting to take off finally, and so I would look for gold to come up here, maybe fill this gap. I think there's a gap right there. Maybe come all the way up into this 1540 area. So gold looks potentially really strong for at least a few months. Same thing with silver. Silver, chopped around a lot and then kind of did a flush and is really coming out of that. So I would look at silver. Silver's it's the next best thing to gold. So that's all we need to know about that, right? All right, let's switch over. I want to look at the euro on MT Predictor, because it looks a lot like, you can kind of see a 1, 2, 3, 4, maybe a 5 down to here. So I want to put some DPs on the chart just to help. These are weekly charts. So where do we put the DP? Where do we click from? So here's the high. So this was the last swing into the high right here, this pivot right here. So I want to click on that pivot and put my DP. And of course, you can see the market came down to that and then bounced and came down again. So the question is it going to bounce higher, or is it going to bounce a little bit higher and then go lower from here? I don't know. Nobody knows. So it's possible that this was 1, 2, 3, 4 into here, into these 6 or 8 candles, and then 5, and now this is A of an ABC. That's possible. Again, this is the euro. So the euro US dollar are going to be really important instruments to be looking at. The US dollar index is going to be an important thing to be looking at. So I want to get you used to it here. All right, the ES. You can see here we've made a pretty dramatic drop. And also this looks like, the first drop with an ABC up or an ABC up, and then we have, these gigantic drops here. And but I want to show you the usefulness of something like an MT Predictor. So let's go back in time. Let's say we were right here, and you're trying to decide what to do. The market's rolled over a little bit, it's pulled back, and you're thinking, well, I don't know. I think there's more to it than this. It's got some more legs. Well, let's say you put a DP on there. Okay, you got a DP on there in advance of the price action. And then, this swing into this high, so let's put a DP off of this last low here, which was right here. Let me stretch it on out a little bit. Move it over. All right, and then let's drop a time frame. Let's go to a daily. Okay, so you can see we had a DP here. Let's just see what that that did on the trade signal. So even the software is picking. What did it do? Huh. Let's fix the, well, I can't tell what it did. I don't think it did the right thing. Let me clear all. All right, so we're on a daily. Well, I'm not sure what it did, but I guess it really doesn't matter. The point is, well, let me try to do that again. Trade setup is right here. Let's do that. Okay, so it picked this area around 2860 for the DP, which is the fourth wave low. Okay, here's the fourth wave. Here's the pullback into the fourth wave, and then a 5. So you can see here it's a 1, 2, 3, 4, 5. But this is likely ABC, so ABC X 1, 2, 3, 4, 5. So this whole move up is counter trend potentially. All right, so let me clear all. All right, so what we want to do is we want to look and we see, okay, where's the market likely to stop? Well, it's likely to stop down here off that previous pivot low into the high. Okay, that's where we took this DP. So according to this, we've got another, 150, 160 points left. So I would say go into next week, without too high of expectations. It doesn't mean you couldn't get a good bounce. You couldn't get a 200-point bounce on the Dow, maybe 50-point bounce on the S&P 500. But it does mean as soon as that bounce is over, it's just going to roll over and go lower. So we just want you to be aware of that. Think about how you would, trade that or something. You can see here from this view, this has a spot for us about right. Whoops. I got to get the right drawing tool. Let's see. Well, let's go. Let's go here and just put a DP or just make an arbitrary DP box. So this is the YM I'm looking at. That's one of the reasons I was confused. I was looking over here. I was like, why are those numbers so big? Anyway, so on the YM, of course, the S&P looks very similar. But we still have a long way to go. I mean, we could go all the way back to here. And that's a long way to go. Again, that's enough. That's a lot of money to give up in your 401k. So we want to try to be proactive. We don't want to predict. That's not really what this is about. Although we are talking in terms of prediction, especially if we can agree that this trend started in 1932. There's something to all this. So just be careful. Pick your spots. Don't, as best you can, resist the psychology because it will lead you astray every time. And keep coming back in here, and we'll keep talking about it and making not recommendations or advice, but just some analysis. Help you with some of the analysis so you can have a better understanding of what to expect. All right, everybody, come in next week and we'll do it all over again. Take care. Bye-bye.